If you're tired of hopping around from strategy to strategy because none of them seem to work no matter how good it looks from your favorite guru telling you that it works 90% of the time and then you go and try it and it works about 20% of the time, or maybe you're blaming it on psychology. You just can't quite control your mind the right way and that is why you're losing. Well, I'm here to tell you your problem is none of that and it's really that you're just focusing on the wrong things when it comes to trading. My name is Corey. I've been trading for over 10 years and I've taught hundreds if not thousands of traders how to trade profitably. And one of the biggest mistakes that I see traders make is overcomplicating their trading, but more importantly, not thinking about trading in the right way. Whenever you look at a chart and you draw, let's say, a trend line, do you ever think why price has to bounce at that area? What's the logic behind it other than it just being a line on the chart? Well, I was doing the same thing for over 5 years. I was a struggling trader and I had no idea what I was doing. I was just following people online who were drawing boxes and lines on a chart and just telling me that that level should hold because, well, it's there and that's what matters. It was only when I changed how I thought about trading that I was actually able to discover the concepts that actually worked. And these concepts are what allow me to now take trades that look like this every single day live on this YouTube channel. So in this video, I'm going to teach you the 3 different concepts that allow me to take trades like this every day. We're going to break down this exact trade at the end of the video after you've already learned all of the concepts and understand why they work, most importantly. And by the end of this video, you will understand trading probably better than 99% of people out there. If you enjoyed this video, make sure to like, comment, and subscribe. That way you'll see my future content. It's absolutely free. With that being said, let's dive into the video. So what is this switch in the way that you think about trading that is going to make all the difference in your trading? Well, it's basically how you approach the markets and how you think about why markets move. Instead of thinking about the markets moving because of a trend or because of a trend line or because of a moving average or because of whatever reason, the shift in thinking that you have to make is basically where are traders trapped? Where are people in pain? Where is max pain? Where are people losing the most amount of money, so much that they can hardly even bear it? Once you view the market as a machine for trapping traders and making them lose, you stop asking yourself why you just got faked out and you'll start asking yourself who just got trapped and where does that push the market. So once you start thinking in this way of basically finding who is trapped, who is in max pain, who is losing the most, that really starts to narrow down the strategies that you trade and the concepts that you want to focus on. So the first concept that you're going to want to focus on, naturally, you've probably already heard of it, but I'm going to explain it a little bit differently in this video, so don't just click away. It's going to be liquidity, okay? Once you understand that liquidity just means stop losses, it makes it very simple. Basically, where are people getting stopped out? Because whenever retail traders are getting stopped out, that's usually when the market has the highest probability of turning around and going the opposite direction. So even though liquidity sounds like a fancy word and a complex concept, it's really, really not. It's just lows and highs, okay? Traders tend to put their stop losses below lows and above highs. They've actually done studies on this. Below lows and above highs are where the highest density of orders tend to be. It's just a psychological thing. We look at the high and low and we think, okay, well, if we break that, then I'm probably wrong, right? But now I'm going to take it one step further and teach you how to actually view the market as a whole rather than just looking for isolated lows and highs and taking every single trade that you see. We can actually take this concept and go a little bit further with it. So traditionally, you're taught that an uptrend is a sequence of higher highs and higher lows. And once you break a low, that's a break of structure. And now you can expect the trend to change. But as I'm sure you already know, if you've been trading for even just a few months, that the market is not that simple. It is not going to just be as easy as higher highs and higher lows. And then once you break a low, that's the end of the trend. And now you can look for shorts. If it was that easy, everybody would be doing it, right? So years ago, on my journey of simplifying my trading and flipping my mindset into trying to figure out where are the most people getting trapped and where are the most people losing money, I've actually discovered a new way to define trend, and it's a little bit more complicated than these higher highs and higher lows, but it's still very easy to understand. So the way that I define trend and the way that we can use liquidity, if I could just get this off my screen. So the way that I define trend is going to be a little bit different because I'm thinking about trend in the sense of where are people hurting the most, where are people getting stopped out, and where are people experiencing the most amount of pain just before the market turns around, okay? And what that's going to look like is going to be a little bit different. Instead of moving in zigzags, higher highs and higher lows and higher highs and higher lows, instead we're going to move in what I call M's and W's. So for a uptrend, it's going to look something like this. You get a high, you get a low, you get a lower high, you get a higher low right here, and then you get a new high, and then you get a higher low, and then you get a lower high, and then you get that higher low again, and then you break out to new highs. And so what are you seeing here, right? It's looking like an M-shaped pattern, okay? Now, why does the market actually tend to trend like this rather than like this, okay? The reason is simple, and it involves liquidity, okay? What ends up happening is that traders will see that we are in an uptrend and we are making a higher high, and so then they think, well, now we're going to make a higher low. What ends up happening is that the average trader will buy the dips, say here and here, on the first pullback in the trend, and then the market goes up a little bit, and they think that they're in profit and everything's going to be okay, and then all of a sudden the market swings down and takes them out right down at this low right over here. Okay, and so what ends up happening is that those traders are either getting taken out for break even, or now they're at a loss and they're actually even potentially flipping their positions. Okay, so the average trader is buying here and then getting stopped out down in here somewhere. Okay, and that's exactly where we, the smarter traders or the simple traders, will be looking to buy, because we're buying after max pain, right? They're getting stopped out. They're wondering why we're going down. They may even be looking for short positions because they think the trend is changing, but in actuality, the trend is only just beginning, and that is when we start buying, which is right after the traders have been stopped out. And so if we wanted to see a bearish example of this, it's basically going to be the exact same concept, but flipped on its head. We make a new low, we make a high, we make a higher low, and then we make a higher high. They think the trend is changing. We take out these stop losses and get people at break even, and everybody's confused and distraught, and then the market actually continues, and then it repeats itself. You get that pullback, traders start to short it. Okay, the market actually does move down a little bit, but then it comes right back up, stops everyone out, and then continues, right? So people are getting stopped out right here, and that's when we start looking to actually take the trade to continue the trend, okay? So the first concept is liquidity, but more importantly, it's the concept of M and W shapes in the market, and that's how you identify the trend. You only look to enter after a high or a low has already been taken out, and those retail traders are getting stopped out or being taken to break even, or the retail traders are thinking that the trend is changing. And so essentially what's happening here is that we're only entering the market after retail traders are thinking that the market is changing trend. And so that's when you want to be ideally on the other side, is when retail traders think the market's going to go one way, but you believe the market will go the other way. So let's take a look at this on the NASDAQ, which is what I trade live every morning. The NASDAQ futures on the 30-second chart. This is the first hour of the market open. And let's just do some structural analysis here, okay? So from the low of the day down in here, we have a low, and then we create a high, and then we create a low, and then we create a high, and then we create a low, and then we create a high. And so right now it's following that typical zigzag, higher high, higher low structure. And so, the trend traders and the retail traders, they're very happy with this. But then all of a sudden we get a low put in, a lower high, and then we take out this low right over here. And so now retail traders that bought here on the first dip expecting another leg higher, just like we saw twice here, right? We got 2 legs higher on the first dip. Now retail traders are buying in this area, buying in here, buying in here, buying in here. They're buying everywhere because they think that the leg is in and we are going to go higher. And then all of a sudden we break this low right over here, and traders now believe that the market is going to go lower, right? They think that that's a break of structure and that the trend is changing, and now we're going to see a downtrend. And look, we even make a lower high right here. But ultimately, what ends up happening is the market continues roaring higher. And so retail traders are left wondering, why the heck did the market go up when we broke structure? And that's because they're not thinking in the simple trader framework, which thinks of trend as M's and W's rather than just these zigzags, okay? So in our definition of a trend, the only area where we would be looking to buy is right after we break this low right here, which is right in here. And you can see that once you start looking for buys below that low, I mean, your entries can be extremely accurate, right? Even if you just wanted to trade based on this concept alone, I'm sure you could probably figure out a decent strategy and get some decent entries. I mean, look at this. As soon as that low is broken, we wick through it and we just continue on in the trend. And so now you're probably thinking to yourself, when does trend actually change then? Well, the trend only would have changed if we broke this low over here. And so basically what this means is that the trend doesn't change until 2 lows or 2 highs are broken, right? So if you have a trend that looks like this, okay, The only way that the trend would change is if we did something like this, okay, which is breaking this low down here. And so you can see we broke two lows, this low over here and this low over here. Now the trend is changing and we might start to see a reversal. Now, the second concept that you need to understand is going to be the trapped traders concept. Basically, where are traders trapped in positions that they are losing heavily on, okay? Now, I know that sounds similar to liquidity, but liquidity is more so traders already getting stopped out or believing that the trend is changing, and so they're taking basically the opposite trades that you will be, and they will lose and you will win. But now this concept is basically we're finding where are traders likely to be heavily underwater, where are they losing tons of money and they just can't bear it, and they'll take any chance they can to get out of their trade, okay? And this is what we call the trap traders concept. And the chart pattern that can help us identify where traders are trapped is going to be the order block. Now, what an order block is essentially a consolidation followed by a very strong continuation in one direction, okay? It can be either up or down. You have a consolidation followed by a continuation in either direction, up or down, okay? Now, the reason why this traps traders is because this consolidation is basically accumulation where traders are entering in trades. Some are buying, some are selling, but in the case that we get this explosive move higher, anyone that sold in this area here is now instantly underwater, losing tons of money. And so what does that mean? What does that tell you? It tells you that they will take any chance they can to get out of this position, because price at the end of the day is basically human emotion on a chart, right? And so if you see an explosive move higher like this, some people are going to be winning, but a lot of people that took shorts there are going to be losing. And the same thing with this over here, this consolidation followed by this massive drop here. Anyone that bought up here is now panicking and waiting for a chance to get out of the trade, because let's face it, not everybody uses stop losses. People trade like idiots. Even some of the best traders in the planet will lose sometimes and trade like idiots, okay? So there's always an idiot on the other side, essentially. And so what ends up happening is that the traders that are trapped in these areas, if price gets back to that area, they will now look for an exit, okay? So if you are short in this area here, once price gets back over there, the only way that you can exit your short is by buying. And so the trap traders concept basically forces traders to buy or sell. So once we get back into this area, those trap traders have to buy. They essentially have to buy because they don't have the guts to keep holding, and it's just too painful, and they don't want to go through it again. And so they buy to get out of their short positions, and price will continue on in the direction. It's like a self-fulfilling prophecy. Same thing for the bearish scenario here, where we have a consolidation and then a massive drop. Anyone who bought in here is now panicking and pooping their pants. And so if price gets back into this area, those traders now will have to sell to get out of their buy trades, and that will push price lower, okay? And so this is basically what an order block is, a consolidation followed by a very violent move away from that area. So the way that we can identify order blocks is very simple. It's basically a cluster of candles, or even just one candle that is very small, right? Just a consolidation candle of any kind, followed by a very large candle in one direction, okay? And so this is basically our order block, right? If we have a small candle followed by a very rapid, massive candle in one direction, basically anyone that took a sell position in this area here between the high of that candle and the low of that candle, this is now our order block, because inside this candle is basically this, right? A consolidation, okay? And then this candle is essentially this right here, a straight move higher. Okay, so that is what's going to be our order block, and then we would expect price to come back into that order block, tap in, and those traders will now be exiting their trades. The trap traders are exiting, and that is when you are entering, and usually we can get a nice continuation higher just like that, okay? So let's take a look at some real examples. So here we are on the NASDAQ once again on the 30-second chart. This is around 10 a.m. This was actually today's price action. And so where is the order block in this chart? It's going to be right over here, okay? Now, why is that the order block? Because again, it's literally a consolidation followed by a out of nowhere, just massive move to the upside, leaving anyone who was in this area to be trapped in their short positions. If anyone got short there, if anyone bet that the market was going to drop there, and then all of a sudden the market skyrockets, now they are pooping themselves, okay? And so what happens? Price goes all the way up, consolidates, and finally retraces back down. And look at how as soon as we come back into that area, those traders that are trapped are now, they're relieved of that stress. And they're thinking, thank God it came back, and they finally exit the trade for a small loss, a break even or whatever. And that forces buy orders into the market, and price goes all the way back up towards the highs, okay? And so this is the trap traders concept, aka the order block. Now, the third concept that is going to help you gauge where people are in the most pain and losing the most money is going to actually be an indicator, a very simple indicator, but very effective indicator called VWAP, okay? It's very simple. You're just going to go to the indicators button on TradingView. You're going to go to technicals, and you're just going to type in VWAP, volume weighted average price. Put that onto your chart, and you will get something that looks like this. Right click anywhere on the indicator and go to settings. And then all you're going to want to do is make sure that the anchor period is set to session if you are a day trader like me, which I figure most of you probably are, okay? If you're a swing trader, you can use week, month, quarter, year, decade, century, but that is not something that I have any experience with. So the VWAP, volume weighted average price, is basically the average price where the most amount of volume has traded. If you take the average of all the volume traded during the session and all of the prices that have been traded at during the session, that is basically what this line represents, the volume weighted average price. So instead of a moving average where it's just calculating average price, this incorporates volume into the calculation, okay? And so basically you can use this as your bull bear line. What do I mean by bull bear lines? Well, basically if we are below VWAP, if we're below this blue line right here, the market is skittish, right? People on average, people are losing money, or they're just shorting, right? They're just pushing the market lower. And so whenever you are below VWAP, that is when you can look to take short trades, okay? Now, if we're above VWAP, it's the exact opposite, right? If you're trading above VWAP, on average, the market is bullish, people are buying, people are going to be buying the dips more often, and the buys are just going to work out a little bit better, okay? And so this is one of the simplest ways to see, on average, are we in an uptrend or a downtrend? It's as simple as that, right? And so you can see, even on just this chart alone, on this day, we were very bearish, and we stayed below VWAP pretty much the whole day. And when we try to get back above VWAP, the market pushed back down, okay? And this is because it's just like the trap traders theory, right? If on average people are buying or selling at this price, this blue line, let's say you're long at this price, right? You bought at this price, you bought at this price, you bought at this price, and price is all the way down here. Well, if price comes back up to your entry point, you are going to take that trade off, right? You're going to do the opposite. And so if you bought up there, now you're going to have to sell. And that's exactly why you see a reaction that looks like this, right? Because anyone who was buying up here, right, their average price was up here on their positions. When the market dumped down lower, when it got back to their average position price, that is when they had to say, you know what, I'm done. I'm losing too much money. I was pooping my pants. And so now I'm going to exit my position. And the only way you can exit a buy is by selling. And so that's why sell orders were there at the VWAP, and we just kept going lower pretty much the whole day from there. Okay, so very simple concept, volume weighted average price. Okay, remember that trade that I showed you earlier in the video? Well, before you watch me trade that in real time, let me break down why I took that trade in the first place so you actually understand. So here's the chart. It was on a 30-second chart, roughly around 9:50 a.m., so really early into the New York session. And so the price was falling off a cliff, essentially, coming down real fast. And so I didn't have much time, but I was able to spot two things. One, we are in an uptrend, right? We have a higher high, higher low, and then a higher high again. But now guess what? If we break that low, are we in a downtrend? No, we are not. So that is our liquidity, okay? This low right here is where traders are likely to get stopped out and be in max pain, right? And so that is the first level, a confluence. The second is going to be right over here. We have an order block, okay? We have a consolidation. You can see this little range right over here. There's consolidation followed by a large continuation. And you can actually see that we came back into that area first to create that low and continued off of that level. But guess what? There's still orders resting here in this area, right? Trap traders that are still not out of their trades are right in this area below this low, okay? And so now we have two things going for us. We have liquidity as well as an order block. And so where is going to be the single most max pain area? It's going to be just under this low here after traders get stopped out, and right in this area here where those trap traders are going to be trying to get out of their trades. And so I'm going to look to buy just under this low here once traders are stopped out, and just in this area here once those trap traders are exiting their trades. And this is what I call an order zone. It's the main strategy that I trade. If you're interested in it, I have a free PDF that you can download down below called the Simple Trader Playbook. And then if you really want to learn with one-on-one mentoring and actually get really in-depth on how to trade these zones, I have the Simple Trader Blueprint, which you can actually get $100 off if you use code SIMPLE100. That is the Simple Trader Blueprint. That is the full 15 video course. I think it's at 16 videos now. You buy it once for life and you get an exclusive Discord room with me and all the other members, as well as the full course, obviously. Now, with that being said, let's watch how this trade played out in real time live on YouTube. Market's moving too quick. No, 810 is the correct area. Got long at 810. Go to a break even, see if I can add to this. Okay, this is looking really good now. Okay. Well, I never got to add, but trying to hold on to my winners a bit better. See if I can. God, this is really hard for me not to take. I'm going to take that. Please let me take that and cancel it there. Boom. Okay, it ran into a wall of orders at 29,900. So I'm just going to take what I can get before the market punishes me for being greedy. So there we go, guys. There we go. That was a $1,700 winner. Not bad, not bad. Thank you guys so much for watching. If you enjoyed the video, make sure to like, comment, and subscribe, and I'll see you in the next one. Peace.